Hello students, welcome to the lecture on cost accounting, and after this lecture we will be able to learn the following objectives. Understand the meaning of cost accounting, explain the importance of cost accounting, define the advantages and limitation of cost accounting, discuss the differences between financial accounting and cost accounting, and describe the elements of cost. Let us start with what is cost accounting. Cost accounting information is designed for managers. Since managers are taking decision only for their own organization, there is no need for the information to be comparable to similar information from other organizations. Instead, the important criterion is that the information must be relevant for decision that managers operating in a particular environment for business, including strategy make. Cost accounting information is commonly used in financial accounting information, but first we are concentrating in its use by managers to take decision. The accountants who handle the cost accounting information add value by providing good information to managers who are taking decision. Among the better decision, the better performance of one's organization, regardless if it is a manufacturing company, a bank, a non-profit organization, a government agency, a school club, or even a business school. The cost accounting system is the result of decisions made by managers of an organization and the environment in which they make them.
Accounting cost is the amount of money that was actually paid for an input such as a machine, truck, or warehouse. Accounting cost differs from economic cost because it does not account for opportunity cost.
Now we will discuss the meaning and scope of cost accounting. Cost accounting is the process of determining and accumulating the cost of product or activity. It is a process of accounting for the incurrence and the control of cost. It also covers classification, analysis, and interpretation of cost. In other words, it is a system of accounting which provides the information about the ascertainment and control of cost of products or services. It measures the operating efficiency of the enterprise. It is an internal aspect of the organization. Cost accounting is accounting for cost aimed at providing cost data, statement, and reports for the purpose of managerial decision making. The Institute of Cost and Management Accounting, London, defines cost accounting as the process of accounting from the point at which expenditure is incurred or committed to the establishment of its ultimate relationship with cost centers and cost units. In the widest usage, it embraces the preparation of statistical data, application of cost control methods, and the ascertainment of the profitability of the activities carried out or planned. A type of accounting process that aims to capture a company's cost of production by assessing the input cost of each step of production as well as fixed costs such as depreciation of capital equipment. Cost accounting will first measure and record these costs individually, then compare input result to output or actual result to aid company management in measuring financial performance. Costing includes the techniques and processes of ascertaining cost. The technique refers to principles which are applied for ascertaining cost of products, jobs, processes, and services. The process refers to day-to-day routine of determining costs within the method of costing adopted by a business enterprise. Cost accounting is often used within a company to aid in decision making. Financial accounting is what the outside investor community typically sees. Financial accounting is a different representation of cost and financial performance that includes a company's assets and liabilities. Cost accounting can be most beneficial as a tool for management in budgeting and in setting up cost control programs which can improve net margins for the company in the future. Costing involves the classifying, recording, and appropriate allocation of expenditure for the determination of cost of products or services, the relation of these costs to sales value, and the ascertainment of profitability. The terms costing and cost accounting are mainly times used interchangeably. However, the scope of cost accounting is broader than that of costing. Following function activities are included in the scope of cost accounting. Cost bookkeeping. It involves maintaining complete record of all costs incurred from their incurrence to their charge to departments, products and services. Such recording is preferably done on the basis of double entry system. Cost system. Systems and procedures are devised for proper accounting for cost ascertainment, ascertaining cost of products, processes, jobs, services, etc. are the important function of cost accounting. Cost ascertainment becomes a basic of managerial decision making such as pricing, planning and control. Cost analysis. It involves the process of finding out the causal factors of actual costs varying from the budgeted cost and fixation of responsibility for cost increases. Cost comparison. Cost accounting also includes comparison between costs from alternative causes of action such as use of technology for production, cost of making different products and activities, and cost of same product service over a period of time. Cost control. Cost accounting is the utilization of cost information for exercising control. It involves a detailed examination of each cost in the light of benefit derived from the incurrence of the cost. Thus, we can state that cost is analyzed to show whether the current level of cost is satisfactory in the light of standards set in advance. Cost reports. Presentation of cost is the ultimate function of cost accounting. These reports are primarily for use by the management at different levels. Cost reports form the basic for planning and control, performance appraisal and managerial decision making. Cost accounting is very important to accountants. Its main objectives are determining selling price. The objective of determining the cost of products is of main importance in cost accounting. The total product cost and cost per unit of product are important in deciding selling price of product. Cost accounting provides information regarding the cost to make and sell product or services. Other factors such as the quality of product, the condition of the market, the area of distribution, quantity which can be supplied, etc. are also to be given consideration by the management before deciding the selling price, but the cost of product plays a major role. Controlling cost. Cost accounting helps in attaining aim of controlling costs by using various techniques such as budgetary control, standard costing and inventory control. Each item of cost, namely material, labor and expense, is budgeted at the beginning of the period and actual expenses incurred are compared with the budget. This increases the efficiency of the enterprise. Providing information for decision making. Cost accounting helps the management in providing information for managerial decision for formulating operative policies. These policies relate to the following matters: determination of cost, volume, profit relationship, make or buy a component, ascertaining costing profit. Cost accounting helps in ascertaining the costing profit or loss of any activity on an objective basis by matching costs with the revenue of the activity. Facilitating preparation of financial and other statements. Cost accounting helps to produce statements at short intervals as the management may require. The financial statements are prepared generally once a year or half year to meet the needs of the management. In order to operate the business at high efficiency, it is essential for management to have a review of production, sales and operating results. Cost accounting provides daily, weekly or monthly statements of units produced, accumulated costs with analysis. Cost accounting system provides immediate information regarding stock of raw material, semi-finished and finished goods. This helps in preparation of financial statements. Cost accounting is also important to employees. Worker and employees have an interest in which they are employed. An efficient costing system benefits employees through incentives plan in their enterprise, etc. As a result, both the productivity and earning capacity increases. Let us study the important advantages of a cost accounting system. These are: a good cost accounting system helps in identifying unprofitable activities, losses or inefficiencies in any form. The application of cost reduction techniques, operation, research techniques and value analysis technique and helps in achieving the objective of economy in concerns operation. Continuous efforts are being made by the business organization for finding new and improved methods for reducing cost. Cost accounting is useful for identifying the exact causes for decrease or increase in the profit loss of the business. It also helps in identifying unprofitable products or product lines so that these may be eliminated or alternative measures may be taken. It provides information and data to the management to serve as guides in making decisions involving financial consideration. Guidelines may also be given by the cost accountant on a host of problems such as whether to purchase or manufacture a given component, whether to accept orders below cost, which machines to purchase when a number of choices are available. Cost accounting is quite useful for price fixation. It serves as a guide to test the adequacy of selling prices. The price determinant may be useful for preparing estimates of filling tenders. The use of cost accounting techniques, namely variance analysis, points out the deviations from the predetermined levels and thus demands suitable action to eliminate such deviation in future. Cost comparison helps in cost control. Such a comparison may be made from period to period by using the figures in respect of the same unit of firms or of several units in an industry by employing uniform costing and inter-firm comparison methods. Comparison may be made in respect of cost of jobs, processes, or cost centers. A system of costing provides figures for the use of government, wage tribunals, and other bodies for dealing with a variety of problems. Some such problems include price fixation, price control, tariff protection, wage level fixation, etc. The cost of idle capacity can be easily worked out when a concern is not working to full capacity. The use of marginal costing technique may help the executives in taking short-term decisions. This technique of costing is highly useful during the period of trade depression, as the orders may have to be accepted during this period at a price less than the total cost. The marginal cost has linear relationship with production volume, and hence in formulating and solving linear programming problems, marginal cost is useful. Let us now learn the limitation of cost accounting. These are: it is expensive because analysis, allocation, and absorption of overheads require considerable amount of additional work. The results shown by cost accounts differ from those shown by financial accounts. Preparation of reconciliation statement frequently is necessary to verify their accuracy. This leads to unnecessary increase in workload. It is unnecessary because it involves duplication of work. Some industrial units are functioning efficiently without any costing system. Costing system itself does not control costs. If the management is alert and efficient, it can control costs without the help of the cost accounting. Therefore, it is unnecessary.
Dr. Lisa, you give a lot of speeches to business owners. Tell me again, what drives you nuts?
Brad, it's when someone says, "We lost money on that job."
That's cost accounting talking. It's amazing the owner is still in business, saying something like that. If his competition didn't all think the same way, he would be out of business.
In theory of constraints, truly variable costs like materials, outsourcing, freight, and sales commissions are normally just a fraction of the selling price. There are only two ways to lose money on a job. 1. Charge less than your truly variable costs, or 2. Rework a job over and over again, causing you to incur the truly variable costs multiple times, and the total of all the truly variable costs are more than the price you charged.
The all-industry average for truly variable costs is 40%. And machine shops, for example, are usually much less than that, depending on the type of work they do. So why does the business owner think he lost money on that job?
It's the allocation of overhead cost, the number one conceptual mistake of cost accounting. Remember, cost accounting was invented back at the turn of the last century, when labor was paid piece rates and overhead was less than 10% of total costs. What really happened was that the job took more time than estimated. And since cost accounting allocates cost to that time, the job cost more than expected, perhaps more than the price. But this is a mirage. The margin received, the sales price minus the truly variable costs, is the same, no matter how long the job took to produce.
So, the problem is that, by using more time than estimated, there is less time left in the month to produce and ship the margin on subsequent jobs. Sometimes, what margin is shipped, in total, is less than the fixed costs for the month, and then there is a loss for the month.
Yes, and that is the problem that most owners are trying to avoid. And the way we were all taught to do that is cost allocation. However, you can make sure that you make enough margin in total without allocating any costs, and it's actually simpler and more straightforward. Just plot the margin dollars you ship every day, what we in theory of constraints call throughput, and compare that to your operating expenses. And remember, if you work overtime, you've increased your operating expenses. Once you understand the relationship between throughput and operating expenses, you have all the information you need to ensure you ship enough work in total to make money. If you can't imagine such a graph, you can see one at scienceofbusiness.com/T versus OE. JPG. A company can lose money, but a job rarely does. Jobs aren't unprofitable, and for that matter, products are rarely unprofitable and customers are rarely unprofitable. Companies lose money because the margin in a month does not cover the fixed costs for a month. Otherwise, the margin on all jobs, products, and customers, in excess of that month's fixed costs, all collectively add to the overall profits for that month.
Is this really that important? In the last 20+ years since throughput accounting was invented to replace cost accounting, not very many business owners have even heard of it, much less felt a need to change.
True. Most just went out of business slowly. Like the frog in the pot when the heat slowly increased and never jumped before it was cooked.
When I switched the label printing business I owned from cost accounting to throughput accounting back in 1997, it was uncomfortable. The process took time and perseverance. And there wasn't much help available for me back then. But I found a sweet spot where conventional cost accounting leads business owners to believe they'd be losing money on jobs, and where throughput accounting clearly indicated we were making a load of money.
Elements of cost are considered to arrive at a total project cost estimate. The elements of cost are generic in nature. They are not considered as definite examples since the accounting practices of different firms and organizations may vary greatly. The definition of the cost parameters is usually not the responsibility of one department of the organization. The main aim is to give an idea of the various components that are included in the total project cost. The elements of cost include direct materials, direct labor, and expenses. Direct materials are materials which can be conveniently identified with or allocated to cost centers and cost unit. It refers to the materials from which a product is manufactured. These materials enter into and form a part of the product. For example, timber used in the manufacturing of furniture is a direct material. Direct material is a component of prime cost. Direct material directly varies with the output. There are broadly three elements of cost. Material. The substance from which the product is made is known as material. It may be a raw material, for example, timber for furniture and leather for shoe, etc. It may also be in manufacture state components, for example, battery for car, speaker for radio, etc. Materials can be direct and indirect. Labor. Human efforts used for conversions of materials into finished products or doing various jobs in the business are known as labor. Payment made towards the labor is called labor cost. It can also be direct and indirect. Expenses. All expenditures other than material and labor incurred for manufacturing a product or rendering service are termed as expenses. Expenses may be direct or indirect. Overhead costs are the indirect costs which cannot be directly attributed to any particular cost unit, that is a product, a job contract, etc. They are also referred as overheads. Aforesaid materials, direct, labor and direct expenses are treated as direct costs, and all expenses other than direct costs are treated as overheads or indirect expenses. Overheads are classified into the three groups. Factory overheads. Factory overheads include all indirect expenses which are incurred in connection with the manufacture of a product. They are also known as works overheads or factory burden or works burden. Factory overheads may be fixed or variable. Fixed factory overheads are those costs which do not vary with the volume of production. For example, rent of factory building, salary of watchman, timekeeper, supervisor, expenses on labor, welfare activities, etc. Variable factory overheads vary directly with the volume of production. They include costs of fuel and power, costs of repair and maintenance, costs of normal idle time, of normal wastage and stillage, etc. Administrative overheads. It includes all those indirect expenses which are incurred in respect of general administration and management of an enterprise. These expenses are of common nature and are incurred for the business as a whole. They are apportioned among cost units on some appropriate basis. Like factory overheads, administrative overheads also tends to fix and variable. The fixed administrative overheads include rent and rates on office buildings, salaries to clerical staff, salaries to executives, salaries to managing director and directors' legal charges, audit fees, etc. The variable expenses may include items like stationery, postage, telephone charges, etc. Lighting and heating expenses, they are more of a semi-variable nature. Selling and distribution overheads. Selling and distribution expenses are indirect costs which pertain to the marketing the product or services. They are not directly related to the cost of the products, jobs, contracts or services. Sometimes selling and distribution costs are separated with a view to apportion these overheads on some accurate basis. There are also some other types of costs which are left undiscussed. These are variable overhead. The overhead expenses that vary proportionately with the outlet are variable overhead. Semi-variable or semi-fixed overhead. The overhead expenses that vary with the output but not proportionately are semi-variable or semi-fixed overheads. Fixed cost. In cost accounting, the two main types of costs that analysts are interested in are variable costs and fixed costs. As people studied cost accounting, they realized that certain costs were always the same, while other costs varied. The costs that remain the same are called fixed costs. These costs include things like rent, utilities, office expenses, and depreciation. Variable costs. Variable costs, on the other hand, represent costs that vary based on usage. These costs include many different things, including labor, raw product costs, machine repair and maintenance costs, supervisory costs, and many more. These costs vary based on production levels and the cost of goods. Semi-variable costs. Semi-variable costs include overhead expenses that vary according to output but not proportionately, so these costs are partly fixed and partly variable. Now, in the end, let us summarize what we have learned in this lecture. Cost accounting is the process of determining and accumulating the cost of product or activity. It is the process of accounting for the incurrence and the control of cost. Scope of cost accounting: cost bookkeeping, cost system, cost ascertainment, cost analysis, cost comparison, cost control, cost reports. Objectives of cost accounting are determining selling price, controlling costs, providing information for decision making, ascertaining costing profit, facilitating preparation of financial and other statements. Advantages of cost accounting are that it identifies unprofitable activities, helps achieve objectives of economy, identifies exact causes for loss or profit, serves guidelines for decision making, useful for price fixation, points deviation from predetermined level, helps in cost control, helps deal with many problems, calculate cost of idle capacity, important for short-term decision, helps in formulating and solving linear programming problems. Limitation of cost accounting are that it is expensive, less accurate, has duplication of work, and does not control cost. The elements of cost include direct materials, direct labor, and expenses. Overhead costs are the indirect costs which cannot be directly attributed to any particular cost unit. These are classified into the three groups: factory overheads, administrative overheads, selling and distribution overheads.